going into a more transitionary market, it's really important that you take certain steps to make sure that your deal is secure. I don't want to invest in a deal that could rack out in 2 years when we could be in a different types of recession or different types of economy. Hey guys, it's James Dainard, and we are back on BiggerPockets, and today we're going to talk about how to pivot your business model for passively investing in 2023. So before we jump into how to pivot, let's talk a little bit about what passive investing is and why investors actually do it. So in the Pacific Northwest, I'm an active investor. I'm going out and I'm finding the investment. I'm securing it via contract. I'm lining up the debt. I'm facilitating the rehab plan, getting it fully stabilized, and either keeping it and leasing it up or selling it and dispoing it out. It is a lot of work. Now we get great returns and we do very well with it, but there is so many hours in the day and you start to run out of time that you can actually do these type of deals. And so over the past 2 years, I've expanded out what I've been doing as an investor. Yes, in the Pacific Northwest, we still have 50 fix and flip properties going. We're building 30 development sites and we're rehabbing over 500 apartment doors right now. But I have additional capital and I don't have the resources to get things stabilized in my local market. So over the last couple years, I've invested in outside markets, right? Like as I want to explore different markets, it's a good way for me to invest with different operators. So what does that look like for me over the last 2 years? I've invested in really 3 different types of asset classes. One is apartment syndications, where I invested in someone else's apartment deal. I received a portion of the equity and I got a pref return for the amount of money that I put in. It's a great way to earn a return and not have to do a lot of work. In addition to, it's allowed me to kind of scale and buy apartments and invest in different markets that I don't know as well as the backyard of the Pacific Northwest. Another way that I passively invested is I joined joint venture equity splits. That's where I'm investing in another operator's project. I'm putting up the cash, they're doing all the hard work, and then we split the profit 50-50. And lastly, one of my favorite ways to passively income is just private lending. Often in the Seattle market, because I know it really well, I do private loans for fix and flip operators, wholesalers, to where I'm actually just getting a higher yield rather than an equity split on the deal. Sometimes operators don't want to give away a portion of their deal, and that's okay. What I typically do with that is I lend them the money at a higher rate than what I would on a pref return that I may get on one of my syndicating deals or on a joint venture deal. Instead of getting a pref return and an equity split, I'm just charging them a higher rate. Typically, I'm charging 12% and 2 points for the money I'm putting into the deal. It's a great way for me to collect monthly interest and get passive income. In addition to, I don't have to worry about the whole stabilization and the fix up of the project. My money gets to keep working while I don't have to do any of the work. The only thing I really need to do is make sure that that deal is a secure investment. But in 2023, I'm going to need to make some different changes because the market is going into different types of market conditions. Passive investing can be very, very dangerous if you don't know how to underwrite and vet that deal correctly. You know, as I'm investing in outside states like Phoenix, Arizona, or New Mexico is where I did my syndicating deal, if I don't have the market knowledge on the operator and what the actual asset is, it can be really dangerous and you can lose a lot of money. Over the last 2 years, we've seen rapid appreciation and growth in all investments. So even if you invested in maybe a mediocre deal, you still were going to get a very high return. So going into a more transitionary market, it's really important that you take certain steps to make sure that your deal is secure. When you're passively investing, you're not just investing in a real estate asset, you're investing in the operator. And it's really important going forward that you want to make sure that these people know how to move in and out of all different types of markets. Again, the last 2 years have made us all look really good. When the assets are going straight up, you can basically buy anything, operate anything, and you're going to make that great return. But those days are looking like they are numbered. So by vetting your operator correctly, you're going to be able to reduce these risks and avoid bad scenarios in the future. So things that I'm doing before I invest in any other operator's deal is I want to make sure that they have experience. I really want to vet my operator correctly. So over the last 24 months, the market has appreciated at the highest we've ever seen, and returns have been through all-time highs. We were seeing returns of 40, 50, even 100% returns on their investment on short-term fix and flip and development. So as a passive investor, you could feel very comfortable investing in that operator's deal. They secure an investment. They have a pro forma. Many times the market would help that performer exceed what they were actually predicting. But as we go into a more transitionary market, you have to be very careful about what kind of deals you're putting your money in, and then what kind of operators you're actually investing in as well. So as a passive investor myself, the things that I'm looking for when I'm vetting my operator is to make sure that they have market knowledge. I don't want to invest in an operator that only has 2 to 3 years of experience. They only know one type of market cycle, which is just like this. That doesn't mean there's anything wrong with that operator, but it could tell me that they're gonna have problems pivoting if the market kind of starts transitioning at that point. So as we go into a new market where we can see some declines and some flattening out, there's certain things that I wanna make sure that my operator has before I invest with them. Right now, I'm gonna be investing in different types of operators than I have for the last 24 months. The operators that I wanna be focused on are ones that have been through numerous different market cycles. So for example, my partner and myself, Will Heaton, we've been through numerous different market cycles in the Pacific Northwest. We started in 2006 when the market was crazy hot. Then we saw a crash in 2008. We saw a flat market in 2011. And then we just went through a rapid appreciation market. Every one of those cycles have taught us how to pivot and change up our business and know how to adapt to keep up with the market trends so we don't get caught with that bad investment. Another thing I'm doing to vet my operators is I want to make sure that they're financially stable. I want to make sure they have the liquidity just in case things go awry. The predictions for 2023 is we're going to be going into some sort of recession. When you're going into recession, you want to have some gunpowder on the sidelines. You want to make sure that you can weather any type of storms. So if I'm investing in an operator that is solely dependent on raising outside capital, that's going to be a concern of mine. So if my operators do not have liquidity, I'm probably going to pass and move on to another one. Another thing I'm doing to vet my operator is I want to go through all their paperwork and make sure that it is all in line. I'm not going to invest in anybody's deal if their paperwork's not put together, or if they need me to help them with the paperwork. That's showing lack of experience, and I'm probably going to stay clear from that as we go into a more flatter transitionary market. So after I've done vetting my operator, looking at their experience, their liquidity, and what kind of paperwork they're working on, the next thing I need to do for 2023 is change how I underwrite deals or how I'm looking at an operator's deals. I really need to dig deep into those numbers. Again, over the last 24 months, the market has gone absolutely crazy. So you can invest in a deal and chances are that the metrics were going to actually be low and you're going to exceed that on any pro forma. But as we go into a flat or a declining market, it is essential that the numbers are correct and the operator can hit all these benchmarks. So when I'm vetting their underwriting, there's certain things that I'm looking for. The first thing I'm doing is looking at the age of the data. And it really depends on what kind of deal that you're actually looking to invest in. If it's a fix and flip deal, I want to see very recent comparables, 30 to 60 days. If my operator is taking comps from the spring when the rates were half of what they are at now, I'm going to know to kind of throw those out, and those numbers probably aren't real. So dig into how are they evaluating that asset and putting on that value of that deal. The next thing I want to dig into the underwriting is how much growth are they putting in. If they're factoring in appreciation, I'm going to throw that out. If they're going to factor in rapid or high rent growth, that's something I'm going to be very cautious of. Those two aspects have been accelerated over the last 24 months to not normal acceleration rates. And so if they're using those metrics to predict the next 12 months, they're probably bad. In addition to, if an operator's bringing me that kind of deal, I'm going to be cautious to invest with them anyways, because that tells me they don't know how to kind of dictate different types of market cycles. So be wary of the growth. Any deal that I'm looking at flat metrics, not growth. Another thing I'm doing to mitigate risk in investing in outside states is I'm hiring third-party evaluators. Now, many of the operators that I've invested in, I do trust very well. I know them really well, but I still want to double check their numbers. As the investor, it's up to me to verify their metrics along with my operator. So going forward, I am now hiring BPO specialists and appraisers to evaluate that deal if I don't know it well. I can invest in any deal in Washington and be very, very comfortable. I know most markets here, I can evaluate it myself and I can make sure that my money is protected on that deal. If I'm in another state, like Arizona, I don't know it as well. I don't have the same access to evaluating that property. So for me to spend an additional $500 to $1,000 to protect my investment by hiring an appraiser or a BPO, it's well worth the cost. And it helps me mitigate my risk dramatically. So don't be afraid to spend that $500 to $1,000 to protect your investment. Another thing I'm doing to mitigate risk for my passive investing in 2023 is avoiding long, complex deals. I don't want to invest in a deal that could rack out in 2 years when we could be in a different types of recession or different types of economy. As we go into a transition, I want to stay in deals that are keeping in the same market cycle. Or I want to invest in deals that have things locked in like interest rates in today's market cycles. So variable debt, long complex deals, things that I don't know what's going to look like in a 12 to 24 months, I'm just staying clear from. 2023 is going to shape up to be a lot different than 2022 and 2021. For those 2 years, we saw so much liquidity on the streets. People were desperate to deploy their money, put them in all different types of deals, whether it was lending, syndicating, development, JV deals, and the amount of money moving around was just crazy. But in 2023, it's going to be a different thing. There's going to be less growth going on. There's going to be decline going on. And as an investor, you don't want to be deploying your money as quickly as we may have been doing the last 24 months. So make sure before you invest in that deal that you are vetting everything correctly. Make sure that you're making these pivots. There is nothing wrong with passively investing, especially in a declining market, but make sure that you're investing in the operators that know what they're doing. I have really enjoyed passively investing. It is my goal for the next 2 to 4 years is to constantly increase the amount of capital I'm putting into other people's deals. I want to work less as an investor. I'm already working 60, 70 hours a week up in Seattle. I'd like to trim that back and let my money work in different ways. But it's only a good thing if I take these necessary steps and change with the market for 2023. I want to thank everyone for tuning in. If you liked this video on how to pivot your passive investing for 2023, like and subscribe below. And for more information on how to passively invest safely, go to jamesdainard.com or on Instagram at jdainflips.